Hey everybody, Joshua Phillips here, Churchill Mortgage. Let me first say an early Merry Christmas. Today is Thursday, December 19th. It's been a couple weeks since I've done a market update. I kind of wanted to wait till after the Fed meeting yesterday, and boy, was it a doozy. Now, I think I'm going to headline this or subject line this with Fed hurts mortgage rates. And, we'll kind of unpack that a little bit, but let me just say, it's not been a couple good weeks for mortgage rates, and yesterday was terrible. So what we usually like to show you here is a mortgage-backed security chart. If you've been following this for a while, this is following mortgage-backed security prices, and this is a Japanese candlestick chart. As I always say, ask ChatGPT or Google it to learn more about that. But these charts are very helpful in showing the movements of price. Now, when you're looking at mortgage-backed securities, you got to keep in mind that it's working the opposite of mortgage rates. So the higher the security price, the better mortgage rates are doing. And then, of course, the lower the security price, the worse rates are doing. Also, green is good, red is bad. So with that information, let's take a look here. This is the last 90 days, and we probably ought to just go ahead and pull out to a 6-month chart here. I'm even going to go ahead and pull out to a 1-year chart. Let's just get wild and crazy here. So let's recap what's happened here in 2024. We saw security prices rising through the end of 2023, and mortgage rates got to a pretty good spot early in 2024, and then things fell off, and we saw rates get back into probably the mid sevens, maybe even upper sevens again back in April of this year. And then, boy, we went on a nice run as security prices improved. And we saw rates get maybe into the mid or even the low sixes back in September. But you know where the peak was? The peak was exactly where the Fed started cutting the Fed fund rate. And since then, we've come down. My last update a couple weeks ago, we were actually starting to move back up, see mortgage rates improve, and then bam, we are back down again. So let's pull this back to a 90-day chart here. We had this little spot back a couple months ago where we're like, okay, maybe we're reaching a floor support and mortgage rates aren't going to get any higher, and they start to improve, and then we've crashed back down. I mean, yesterday was a pretty terrible, it was a big red candlestick. That means it's a very negative day. Rates probably jumped an 8.25% just yesterday. So what's going on? I'll do my best to explain what is happening. So I think in reading a lot of commentary, listening to a lot of videos myself, I think a lot of people feel that Fed Chair Powell has really kind of botched what has transpired the last few months. Maybe he did too much of a cut with the Fed fund rate in September, and then people are questioning whether he should have done a cut this month. But all of it really comes back to that word we haven't talked about in a while. I don't think I've used the word inflation in a while, but it all comes back to inflation, and it's continuing to stay around. They want inflation to be at 2%. We got down close to that, but it seems like inflation's going up a little bit. And so, and then of course the Fed said yesterday, they're like, hey, you know what? Next year we're probably not going to do 4 cuts. We might do 2 cuts, and we're just going to have to wait and see as inflation is maybe rising a little bit. Now, I haven't said this in a while. The Fed fund rate is not mortgage rates. The Fed fund rate is a overnight rate that banks charge each other. It does typically have an influence, but it's not mortgage rates. And there's a lot of other factors that go into mortgage rates and mortgage-backed securities, including, if we take a look here, this is something that any of you can do, is follow the 10-year Treasury yield. I've pointed this out as something you can kind of track that does follow pretty closely. So the 10-year Treasury yield, again, back in September, we want to see the 10-year Treasury yield go down. That would be good for mortgage rates. And it was trending down. Again, right around to September when the Fed cut the Fed fund rate. But since then, I mean, we got down to about 3.7, 3.6. Now we're up to almost 4.6. That is not good. So think about this. So an investor can go out and get 4.5% on a treasury bond that really has, considerably no risk to it. And so if they can get that much, 4.5%, there's always going to be a gap there between mortgage rates, and that's what's pushing mortgage rates higher, because they're like, hey, I can go out and get investors looking, I can go out and get 4.5% right now on a treasury yield without any risk versus a mortgage-backed security. So again, as these treasury yields rise back up again, that is not good for mortgage rates, and it is pushing mortgage rates higher. Again, I always want to say we have to talk about specific situations. There's like 30 factors that go into mortgage rates, but we're probably looking at north of 7% right now, or, buying your rate down back into the sixes, you can still do. But mortgage rates have definitely come up considerably the last 2 or 3 months. I hate to say that. I keep wanting to come to you with good news, but man, it was ugly. It's been an ugly run, to go back to the securities chart. So I don't know where this leaves us for 2025. My last update, I did show a chart with some of the, key, Fannie Mae and the Realtor Association and stuff, what the projections were, which were basically rates in the sixes next year. I still hope that's true, but we may see rates go up before they go down. And we may be hovering back in the low sevens again before hopefully we get back into the sixes. So it's not been a good run. Merry Christmas. And obviously there's more to life than mortgage rates. And they are better than they were a year ago, for what it's worth. Or see, as far as last fall, we got up over 8%. So I mean, we are a little better than we were then. But sorry, this is a long update. A lot of information to share with you, and we'll certainly hope for some better news. We need, what do we need? We need inflation to come down, which means unemployment needs to go up. Of course, we got a new presidency getting ready to start, so we'll see how tariffs and all that. So just hang tight, because it may be a little bit of a rough ride for a while. Again, if you need to work on a pre-approval, if you need to talk about your situation and specific mortgage rates, I'm happy to do so anytime, although we're heading into Christmas next week. So, but I will be working as needed over the next couple weeks, and happy to help you. Merry Christmas. Take care. Bye-bye.